The first one is fraudulent financial reporting, and the second one is misappropriation. Okay, like the name suggests, the first one, fraudulent financial reporting, it's pretty self-explanatory. It's basically the use of fraudulent practices in financial reporting. Whenever you are reporting the performance of your company, you apply fraudulent practices over there to make your company seem better or worse. Like nobody is going to try to make their company look bad than it actually is. Most of the times, fraudulent financial reporting is aimed at making the company look better than it actually is. Okay, unless you have like a personal agenda against the company, nobody working inside the company is going to portray it worse than it actually is in the financial statements, right? So most of the times, fraudulent financial reporting is applied to make sure that the company seems more appealing to the investors than it actually is, or to show performance of the company in a false manner to the shareholders. For example, if the company is performing poorly and the directors are worried about some kind of repercussions from the shareholders, they'll try to apply fraudulent practices in financial reporting to make sure that, some way or the other, the company looks like it's performing well. Okay, and there are like a lot of different methods for this. Like there is a now this is not exactly fraud, but it's something that is very closely related to fraud, which is creative reporting. A creative reporting is when an accountant uses loopholes in accounting practices to make sure that the company is portrayed well. For example, the changing of depreciation policies. If the company has, let's say, net liabilities, and they want to increase the value of their assets, so they can either do a revaluation, or they can change the depreciation method, which will have an effect on the asset values. Okay, now this is not exactly illegal, but it's unethical. Okay, so there are some extra considerations over there which we don't have to study in detail. We just have to understand what is fraudulent financial reporting. Okay, and another example can be window dressing, wherein during or like close to the year end, the company involves itself in a lot of transactions to make sure that the company looks like it's doing a lot of business, but in reality, it's only happening close to the year end, so that whenever the financial statements are being prepared, it looks like the company is performing well. For example, moving a lot of money into the company accounts close to the year end and removing them right after the year end. This will make it look like the company has a lot of cash in the financial statements. But in reality, the cash is not actually there. It's just movement of cash close to the year end. Okay. So that's what fraudulent financial reporting is. And the second type of fraud, which is misappropriation, is straight up theft. Okay, it's straight up stealing from the company. It can be inventory, it can be cash, it can be purchase of assets for personal use using company accounts. Whatever it is, misappropriation is basically theft. Okay, so these are the two types of fraud that can happen inside a company. Okay, now we all know what an error is. An error is a mistake that's unintentional in nature. It was not done deliberately, right? That's what an error is. And we know various places wherein errors can happen inside the financial statements, right? It can happen when data is being transferred from one place to another. Like, for example, if data is being transferred from general ledger to the financial reporting process, the financial statement preparation process, then in between the transfer, a mistake might happen, and this will lead to a misstatement inside the financial statements, right? Or an incorrect accounting estimate, which is prepared by the management. Okay, now this accounting estimate, if it is done intentionally, then that constitutes a fraud, right? If the management is intentionally extending the useful life of an asset over a reasonable basis, then that's a fraud. But if the management is doing it in, like, unintentionally, in the sense that they are not doing it deliberately, then that becomes an error. Okay, so this is basically what constitutes a fraud and error, and it's pretty straightforward. We all know that the people responsible for preventing fraud is basically the people who are running the company, right? So that's basically directors, or those charged with governance. That's what we call them, right? Directors, along with audit committee, are called those charged with governance, and they are the people who are responsible to prevent and detect fraud inside the company, because they are the people who are running the company, right? And the way that they do it is by implementing an internal control system inside the company. Obviously, they cannot personally check all the transactions and everything for fraud or error, right? So what they do is they implement internal controls. And we've discussed this before, that internal controls are basically processes or procedures implemented by the management to make sure that fraud or like misstatements inside the financial statements are prevented, detected, and corrected. Okay, that's basically what internal controls are. And internal controls exist on all parts of the business, on in all areas of the business, right? So if the internal control system is effective, then that means that the fraud, like the chances or the opportunities for fraud occurring in the company will be very low. Okay, so that's the first method using which they control fraud inside the company. The second one is to create a culture of honesty. The first one is direct method, right? You implement things or you implement internal controls to make sure that fraud doesn't happen. That's direct controls. Okay. The second one is more indirect in nature because you're not exactly directly influencing fraud, but you're doing things which will influence fraud indirectly. You create a culture of honesty, ethical behavior, and active oversight. Like by doing all this, you can ensure the integrity of your employees, and because of that, fraud will be reduced. Okay, now this is more of a soft control rather than like a hard or direct control because this will not directly prevent any fraud from happening. But because there is a culture of honesty, because there is a culture of ethical behavior, people will be deterred from committing fraud. Okay. Now, as part of internal control, now there is a system of internal control which we have to discuss in a later chapter. But as part of this internal control system, there is a risk assessment process. So in this risk assessment process, what they do is they look at different parts of the business. They identify where there might be problems, where there might be fraud, where there might be error. And if they think that that's a significantly risky area, they implement an internal control over there. Now, this risk assessment process is necessary for fraud. Okay, to prevent fraud, you need this risk assessment process. You need to look at different parts of the business, and you should be able to say that, by by comparison, this area has more susceptibility to fraud, and because of that, we must implement an internal control over there. Okay, so that's basically the risk assessment process, and just implementing the internal controls is not enough. You have to constantly monitor them, right? You have to see if people are following those internal controls, if that internal control is working effectively or not. Okay. And the person or the people responsible for doing this is the audit committee. Okay. They are the people who are going to look at internal controls to see if they're working effectively or not and take remedial actions if they're not working effectively. Okay. Now, audit committee doesn't directly do this. They take the help of internal auditors to do this for them. Okay. So that's basically what the director's responsibilities are for fraud. Now, with relation to fraud and error, internal auditors assist the directors, right? Internal auditors assist the audit committee. Those starts with governance, basically, to prevent fraud inside the company. Okay, now there are a lot of different things which the internal auditors can do, which we will discuss in a later chapter, which is coming up.